What we've done so far in this lecture is develop the structure of the Solow-Swan model of economic growth, an extraordinarily famous model in the history of economics. As you've seen, it gives us a great deal of insight into the process of economic growth. I should say before we go much further that there's been a great deal of work refining this model, building on it, and introducing a whole range of real-world features that has provided even more insight into economic growth. And if you go on to study more macroeconomics, you'll certainly encounter those more advanced versions of this model. But what I'm demonstrating for you here is the model as it was originally formulated, which, simple as it is, provides us, I think, with some really important insights into the process of economic growth, insights that I'm very keen to share with you. So let's just summarise a little bit. There's the model, and as we've seen, the absolute key to understanding the model is the notion of the steady state. You can think of that point, and this is probably not a bad way to think about it, as what is sometimes called an attractor. What I mean by that is that we have forces in the economy that are pushing the economy towards that steady state. It doesn't matter if your capital-labour ratio is to the right of that point or to the left of that point. As we've seen, there is a tendency for the economy to be moved towards that point. It could take many years, but you're going to get there. The other important thing to note about the steady state, about the attractor, is there's no growth if you're in the steady state, and that is no growth in per capita income in the steady state. And why I think that is so important is because it clarifies for us what we mean when we talk about economic growth. Growth in per capita income is actually the economy growing to the steady state. But as we previously discussed, that has with it the implication that there must come a point in time where growth stops, where the resources that are made available through saving cover replacement investment, but no more. And that raises this interesting issue of, well, why do we observe so many instances of long-run growth in the real world? We looked at one possibility, a growth in the proportion of income that's saved, and we saw that that wasn't a complete explanation, because whilst that would shift the steady state to the right and as a consequence lead to some economic growth, that would only be temporary, because eventually the new steady state would be reached. So how then do we explain continuous long-run growth? How do we explain growth in the United States, Western Europe and other economies going back hundreds of years? Well, the Solow-Swan model tells us where to look, and that's, I think, its main contribution. It tells us that we have to look to forces that are shifting that steady state continuously to the right. Because if the steady state is shifting continuously to the right, in other words, if that steady state capital-labour ratio is becoming increasingly larger, and that's always happening, if there's continuous growth, in other words, in that steady state capital-labour ratio, maybe economies never catch up to the steady state. Maybe they're growing towards a moving target. And when we see hundreds of years of economic growth, what we're actually seeing is the economy trying to get to the steady state but never quite reaching it, because the steady state itself is growing. And where can that come from? total factor productivity growth. So let's just backtrack so I can tell you the story in a bit more detail. Suppose an economy is at its initial steady state at A star. We know all about the characteristics of that steady state now. But suppose there is growth in total factor productivity. What is that going to do? It's going to shift the production function upwards. What else is that going to do? It's going to shift the saving line upwards. But this is a different shift to the one I had in the previous slide. This saving line will still feature the same savings rate. We've not grown the savings rate here. It's still 40% of income. The point is it's now 40% of higher income. So as the production function shifts up, so too does the savings function. What does this do to the steady state? We have a new steady state, B star. And now it's exactly the same story that we had before when we have an economy below the steady state. A star is no longer the steady state. B star is the steady state. We will have a gap between saving, which is now read off the new saving schedule, and replacement investment. Net investment will be positive, the capital labour ratio will grow, and we'll get economic growth. Why doesn't it stop in the new steady state? Well, it might if that was the end of the story, but why should it be the end of the story? What if there is another increase in total factor productivity? I won't represent this on the diagram, but you can see, I hope quite logically, that that will once again shift the steady state to the right. And so on. Long-run continuous economic growth has to be associated with a process of continuous change in total factor productivity. Nothing else will do it for you because everything else means you fall into the steady state eventually. But if your production function is always shifting upwards, and if it's always dragging the savings function up with it as well, so that the steady state is itself continuously growing, then economic growth may occur over very long periods of time. Simply put, you never get to the steady state because the steady state itself is growing. So let me summarise this. Economic growth at a fundamental level is going to require an increase in the ratio of capital to labour. It's going to require more capital to labour. And think about this as, in fact, the means of increasing labour productivity on average. You give workers more machines, they'll be more productive in an average sense. Secondly, if we want to increase the ratio of capital labour, we're going to need net investment. To get net investment, you need to have resources. You need to have resources left over from saving once the economy's replacement investment needs have been met. Now think about the implications of diminishing marginal productivity. Each time you increase the capital labour ratio by 1 unit, you do get some more output, you do get some more income, but you're getting it at a diminished rate. So you're getting smaller and smaller increases in output, smaller and smaller increases in income. So consequently, you're going to get diminished increases in saving. As you grow the capital labour ratio, you grow income, you grow saving, but both income and saving are growing at a diminished rate. Replacement investment, however, the replacement investment needs of the economy are growing at a fixed rate, and they're growing at a fixed rate which is determined by the rates of depreciation and population growth. So you've got a tension. You've got a tension between the extent to which there are more resources being freed through saving and the resources that are needed for replacement investment. The resources that are being freed from saving, as the capital labour ratio grows, they are increasing, but increasing at a diminishing rate. The resources needed for replacement investment are increasing, but they are increasing at a fixed rate. Eventually, this means a steady state will be reached. And the steady state will be reached when that flow of saving is just sufficient. No more, no less, but just sufficient to cover the economy's replacement investment needs. There's nothing left over for net investment. The capital to labour ratio stops increasing and the economy is at the steady state. The implication of that is there is no further growth in per capita income, which also remains at its steady state level. What does that tell us? It tells us if you want continuous long-run economic growth, you need to grow the steady state as well. You need to make sure you never catch up to the steady state. And in this framework, what that is going to require is a continual process of total factor productivity increasing. And when economists think about this and what this means for the real world, what we usually think about is technological progress. Technological progress which has happened at a sort of continuous rate ever since really the Industrial Revolution. It's technological progress that is almost certainly driving this process. So when we look at the chart that we began with, this remarkable observation that the rate of economic growth is not much different in the 21st century to what it was in the 19th century, we now know that that rate of economic growth over this long period of time must, at a very fundamental level, be reflecting improved total factor productivity, and over this long period of time, it's almost certainly related to technological improvements. And therefore it's the rate of technological improvement, that continuous technological improvement pushing total factor productivity up, causing the steady state to shift gradually to the right. That is what is ultimately underlying this incredible observation about economic growth.